Hey, what's up guys? Curtis here with Long Trend. So today we're going to take a look at Intel stock. It's a $49 stock that's trading at a 6 times enterprise value to EBITDA. Today I'm going to pull Intel's financials into the model. We're going to look at Intel's revenue, Intel's cash flow. We're going to look at their dividend coverage. Then we're going to flex it to the downside to see if there's a margin of safety by buying the stock today and holding it for the long term. So if you're ready, let's get into it. Okay guys, so a few points about Intel. They're a $200 billion market cap company with zero net debt. They've got an 8.5% free cash flow yield assuming no growth. So that's $18 billion over $200 billion. Over the last 10 years, they've got a compounded annual growth rate of 6%. Now, it's not going to be that going forward or certainly over the next few years, but they have grown over time, and they've grown their dividend over the last 10 years at 7%. Their dividend coverage is 3-to-1, and they buy back about $12 billion of stock per year. And most importantly about Intel, it's trading at 5.8 times enterprise value to EBITDA. To add some perspective to that, Google is trading at 25 times, Home Depot is trading at 18 times, McDonald's is trading at 20 times, and Kroger is trading at 9 times. So Kroger, the grocery store chain, with lower growth than Intel, is trading at a higher multiple. With no net debt currently, Intel has the capacity to add about $90 billion of debt to their balance sheet. That would bring their net leverage to about 3 turns of EBITDA. Another interesting thing about Intel is that they're big buyers of their own stock. And because their stock trades at 6 times enterprise value to EBITDA, they get to go into the market and buy back their stock at a cheaper valuation than any other large cap company virtually. So the effectiveness of the share repurchase program for Intel is very, very good because they get to buy back their own stock at a very low valuation. Okay, so if Intel was on the same trajectory as it was, they'd be currently priced for a 17% implied expected return. Now, that's likely not going to happen. So what I am going to do is I'm going to input recent guidance that the company has announced, and I'm going to see the impact on this number. So if I go to Yahoo Finance, I can see that there's 35 analysts that have Intel at $74 billion of revenue next year. Okay, so let's plug that in. So they're at $78 billion through trailing 12 month. So what I'm going to do is I'm going to put a negative 6% growth for this year. Then I'm going to hold growth flat for 5 years. And then I'm going to say growth normalizes to 5% thereafter, which is more in line with historics. Okay, so 16% went to 12%. That's still a market-beating return, and especially so in this market where valuations are extended. Next, Intel has also guided the market that they're going to spend more on capital over the next few years. So what I'm going to do here is I'm going to increase my capital as a percent of revenue to 35%. So that's going to give me CapEx of 25, 25, 24, and then it's going to fall back to a more normal level of $18 billion. Okay, so if that comes true, the free cash flow will be significantly less over the next few years, but it is likely to grow back to a more normalized level of around $15 billion a year. So will that level of free cash flow impact Intel's dividend? Intel grows their dividend at 7% a year, and they have for a long period of time. So right now they pay $5.6 billion in dividends. The dividend coverage over the next couple of years might be negative, but they also have $40 billion on their balance sheet that they can use to fund a $5 billion dividend for a while. And again, they could lever up their balance sheet up to 3 times with the level of cash flow that they generate, which gives them ample room to borrow and pay for their dividend if they have to. What does this mean to me as a potential shareholder of Intel? Well, I can go into the market today and buy stock in Intel for $50. If I held on for 10 years and didn't sell, I'd likely collect the dividend to be able to grow at 7%. And then I can see a path for Intel where their stock is actually trading north of $100 in 10 years' time. And that can be a mixture of cash generation and also, because they have the debt capacity to do so, they can use some leverage and buy back some of their own stock at a very cheap multiple. And if that comes true, if the stock roughly doubles over a 10-year period and I collect the dividend, that works out to an expected return for Intel of about 11% that I would earn by investing in Intel today and holding it for 10 years. So there you have it for Intel, folks. I think Intel represents an interesting opportunity in the market. And in fact, the 10.6% expected return, I'm actually going to call that the downside because that assumes that Intel stays at 7 times enterprise value to EBITDA. If Intel also gets a re-rating in their multiple over the next 10 years, their multiple could go from 7 to 10x, and that would actually be a 13% expected return. I'm going to be doing more of these videos going forward, so if there's a particular stock that you want me to evaluate, please let me know in the comments. And thanks again for watching, and I'll see you in the next one.